Hi. In the first session, I talked about the corporate life cycle, at least the way I describe it, as including 6 different phases. In this session, I want to give some flesh to each of those phases, talk about what's different about each phase in terms of operations, in terms of finance, in terms of ownership, in terms of capital, and perhaps use it to separate the 6 phases. Let's start with phase 1. You have a startup. Startups, of course, are new businesses being started up. And in this graph, you see the number of new businesses started in the US is in the tens of thousands. So when you look at the total business applications, these are the people applying to start a business. And this is the US government that collects the data. They also keep data on what they call high propensity applications, applications where there's a greater chance that there'll actually be a business. Turns out that a lot of people apply for a business the government knows they're not really serious about starting a business. So when you have a business being started up, here are some of the things you might be interested in finding out. There is this premise that businesses are usually started by young people with nothing to lose. And there are studies that look at what a typical founder in a young business looks like. And this is from a Harvard Business School study that looked at the founder age in young businesses. It's a little surprising. It turns out that the median age for a founder is not young, but more middle-aged, a kind of mismatch between corporate life cycle and human life cycle. There are some young people who start businesses, but I guess you need some capital and some experience to do it. So a little surprising, but something worth noting. In fact, I was a little surprised at how many people who are 60 and older start new businesses, but perhaps I shouldn't be. The desire to own your own business might extend over your lifetime. Of course, the biggest challenge that a startup faces is many of them don't make it. Here again, I'm going to draw on a government database that I find interesting. The Bureau of Labor Statistics actually tracks businesses that are started and tracks them based on whether they survive 1 year, 2 years, 3 years, essentially tracks them through their lifetime. So this is actually from the 2006 cohort of businesses being started up, and the Bureau of Labor Statistics has tracked out how many of them how many of these businesses started in 2006 made it through 2007, 1 year, how many made them 2 years. So as you look at this black line, that tells you the failure rate as you go through time. A couple of interesting things. One is the failure rate is highest early in a business's life. Not surprising, but something worth noting. In fact, the failure rate in the first year is as high as 70%. That failure rate decreases the longer a business has been around. So put simply, a business that's been around 5 years has a much lower likelihood of failure than a business that's been around 2 years. The second is, if you look at the cumulative failure rate, the percentage of companies that don't make it through time, and I track it through 15 years, almost 75% of companies started in 2006 were no longer in existence by 2021. Failure rates are high in young business, and this is a mortality rate we mentioned in the last session. Now let's think about the financial capital and ownership challenges you face at a young startup. First, you're a young startup. You don't have a business yet. You don't even have revenues, but you do have expenses. Those expenses being that you're going to burn through money as quickly as you get it. You're going to lose money. There is really no way around it. It is a feature, not a bug. How much money will you lose? It depends on 2 things. One is your ambition. The more ambitious you are as a founder, the more money you will lose because you have bigger dreams. You'll spend more money. So ambition and potential actually work against you if you think about minimizing losses, because the more ambitious you are and the more potential you see in a market, the more money you're willing to lose. Now, of course, all this money losing has to be covered by capital. Now, if you're very wealthy, you might cover it with your own money, but if you're a founder, odds are you don't have that much money. So who do you tap out? First, you approach family and friends, but soon you might have no family or friends if you keep tapping them out. At some point in time, you have large enough ambitions, you've got to go out to outsiders. Those outsiders, of course, are venture capitalists. Whether they call themselves that or not doesn't matter. And they will give you the capital to cover the cash burn if they believe your dreams will come true. But they will take their pound of flesh. What's a pound of flesh? They will take a share of the business. There's no fair or unfair about it. It's the nature of the process. You wanted capital. They want a piece of your business. That's a quid pro quo that keeps you going. So that's the first phase. Let's move on to the second phase. So you started a business. Your second phase, you're building a business model. Your challenge here, if you're thinking in terms of operating risk, is how do you build a business model? Many people who start businesses are not business people. They might be engineers, they might be software people, they might be retailers. I mean, basically you're starting a business because you know how to run, how to write software, how to run a store. You might need some help in building a business. Where will that help come from? Well, sometimes it comes from the same people who provide you the capital to keep going. Venture capitalists are not just capital providers. They can often, give you management help to kind of help you build a business model. Sometimes, though, as a founder, you might be incapable. You might not have the skill set or the interest in building a business model, in which case you have to look outside to bring in somebody with operating skills, somebody who can think in terms of supply chains and manufacturing, if you're a manufacturing company, to build up the operations in your business. In fact, this tension between founders wanting to build a business and not having the skill set to do so is at the heart of what Noam Wasserman calls the founder's dilemma, which is founders who want their businesses to be successful but don't have the skill set to build a business model often have to give up control of the business to be able to build a successful business. Therein lies the dilemma. Do you want a successful business or do you want a business that you completely control? So as with everything else in business, there will be trade-offs you have to make as a young business where, as you model a business out, you got to decide, do you want to go for growth or do you want to build a model that makes profits? And you're saying it's early. What's the harm in going for growth now? Because the choices you make now might lock you in later. So that's the start of the second phase. Let's carry through and look at the financial challenges you will face as a young growth company. You built a business model, but odds are that you're just seeing the beginnings of revenues. Your expenses, though, are going to be exploding on you. In other words, you will continue to lose money, perhaps even more so than before you built the business model. And how much money you will lose and how quickly you can turn the corner will depend on a couple of things. One is how much of your expenses are operating expenses you have to provide the items you're selling right now, the current revenues, and how much are growth expenses you're incurring because you want future growth. Healthier businesses, more of your expenses. If you're a young growth company, more of your expenses should be for growth than operating expenses. If all your spending is to create the items you're selling right now, it's going to be difficult for you to grow. The second is unit economics. Sounds like a buzzword, right? But let's put some flesh on it. Unit economics captures how much on the next unit that you sell you get to keep as profit. Now let's, if you think about different businesses, clearly the statistics are going to be different. If you're a software company, selling an additional piece of software costs you almost nothing. The unit economics are great. If you're a manufacturing company, you make a machine and you sell it. The unit economics, by their very nature, are going to be more daunting because there is a cost of making the machine. Companies with better unit economics should be able to turn the corner faster than companies with worse unit economics. Third, and this is a challenge as a young company that you face, you want to hire the best people. But remember, you're losing money. You don't have the cash to pay them. So what do? You offer them equity in your company. That equity might take the form of options. It might take the form of pieces of your company. But you're doing it not because you're feeling charitable. Of course, you also have people then thinking in terms of what's best for the business. But your real challenge is using stock-based compensation to reward employees, which means you're giving away pieces of the company today to be able to grow. And you have to decide whether the trade-off is working still in your favor. So growth versus operating expenses, unit economics, and how much you're spending in terms of stock-based compensation. Now, in terms of the capital and ownership challenge, because you're losing money and you have increasingly negative cash flows, you will require capital infusions to keep going. So this is just a hypothetical of what happens to the founder's stake in a company as you go for more and more capital. The capital stages that I've listed here reflect stages that you usually see in the venture capital process, where you have seed capital, then you have Series A, Series B. With each series, you're getting bigger and you're going for more capital. And here's what you're going to see happening. You're going to see the share of the business owned by the founder decrease, maybe not at the same same rate that you see in this graph. The share owned by VCs start to increase. And there's a third component here, which is remember that you're rewarding your employees, especially your top and most valued employees, with equity. Their share of the company will also increase. So again, while not every company will see the same pattern, you're going to see the same phases of shifting ownership. Phase 1, you had a business idea, you started a business. Phase 2, you built a business model. Let's say you make it through that phase. You're in phase 3. You're now at the phase where you're thinking about making your business bigger. The scaling up test brings trade-offs, just like every other phase. The trade-off is going to be between control and capital. Do you want to control a company and give up on growth, or do you want to go for growth and own less of the company? As you grow, scaling up will require founders to give up shares of their ownership, and how much they're willing to give up will determine how much they will end up with the company. Now, as an investor, from the investor's side, you'll often see that the returns you make as an investor often come from the scaling up phase, because that's where you make small business into big businesses. Let's talk about the financial challenges of a high growth business. If you're a high growth business, your revenues are starting to take off, and perhaps if you're lucky, your margins are starting to go from negative to positive. Now, at this stage of the business, your revenue growth might be much more healthy, much greater than the growth in your operating income. But at least you should start to see your earnings move in the right direction, from losses to profits. But this is perhaps what's going to determine successful versus unsuccessful. Now, as you think about scaling up, though, it's worth remembering that not all businesses are designed to scale up. You might decide that being a small, successful business is your end game, and that's not a failure. Choosing not to scale up should not be a failure, because not all businesses were meant to be scaled up. One of my problems with the last decade of businesses, young businesses that got started, was every business was viewed as a scalable business. And in the process, you took what could have been a small, successful niche business and caused it to fail because you pushed it beyond its limits. My favorite example is Peloton, a company that could have stayed a niche business successful but overreached, partly because of the success it had during COVID. And in terms of capital and ownership challenges, this is the phase of a business where the incentive to enter public markets will increase, because up till now, remember, you've got your capital from friends, family, venture capitalists, but at each stage you were giving up big stakes. You say, why would the incentives increase, public markets increase? Because people are getting impatient. Founders, investors, employees. Remember that your company is now owned by those three, and they own equity in your company, but they can't spend that equity because it's not cash. So they want to cash out, and one way to cash out is to go public. The other is, I think you get better trade-offs in terms of how much you give up of your company for capital when you go into public markets. When you get large enough, it might be in your best interest, rather than approach venture capitalists for more capital, to go to public markets. So not all successful companies go public, but the incentive to go public will increase. Now, of course, whether you can go public or not will depend very much on what part of the world you're in. It's easier to go public in the United States than it might be in parts of Latin America or Africa, where essentially as a private company, you might not have the chance to go public. What does that mean? You have to decide then that being smaller is okay, because overreaching and trying to go for capital in those markets might mean giving up too much. Which brings us to phase 4. So you've started a business, you've created a business model, you've scaled it up as much as you can. Now, you are a big business, at least given whatever big is in the business you're in. You're still growing, but the challenge you face is how much more growth can you go for? Remember that this is a much tougher challenge. Growing $1 million company is easier than growing $1 billion company, and you're now $1 billion company. So as companies become larger, most companies give up on growth. But a few companies manage to continue to grow at healthy rates, and those are, of course, our market stars. Now, along the way, though, remember that revenue growth doesn't make for success if it's not accompanied by profit. So you'd like the margins you make, your profit margins, to also improve in this phase of the life cycle. So in terms of business, you're scaling up your business. It's a big business. You want to continue to grow, but you want to also improve your profit margins as you do. As I said, the companies that can continue to grow as they get bigger and improve margins are our special companies. Between 2010 and 2019, 6 stocks, Facebook, Amazon, Netflix, Google, Apple, and Microsoft, FANGAM stocks, essentially were examples of companies that scaled up, were able to grow, improve margins. And those 6 stocks accounted for 15% of the increase in market capitalization of all US companies. During that decade, these companies were special not just because they grew, but they grew as large companies while delivering higher and higher profit margins as they went along. So when you look at a market success story, it's because it's beaten the odds, been able to grow even as a larger company. But remember, those are the exceptions, not the rules. Now, in terms of financial challenges, this is the phase where you're going to harvest the crops you've sown as a young company. Put simply, this is when your profits should start coming to you. Your earnings should start to grow at a faster rate than revenues, because up until now you've struggled, right? You've delivered revenue growth, but you've not been able to deliver profits. This is the phase we should see earnings growth. But that's going to also mean that you're going to see slower growth than you had historically. That slower growth though comes with a bonus. Because you have slower growth, you need to reinvest less. And because you reinvest less while delivering higher profits, you're going to start to see positive cash flows. If you don't start returning those cash flows, because remember, you've never paid dividends, you've never bought back stock. If you continue to do what you've done, this is the stage of the life cycle where you're going to see cash balances start to get bigger and bigger at companies. For successful businesses, this is, I think, the sweet spot. You have the excitement of still continuing to grow and the comfort of positive earnings and solid cash flows. But it's also an adjustment phase in terms of mindset. Because you come off these phases where you were cash poor and you had to pick projects to deliver the highest possible returns. You're no longer cash poor. And that requires a different mindset than you had historically. And only a few companies are able to pull that off. In terms of capital and ownership challenges, this is the phase where you become self-sufficient as a company. You're no longer dependent on external capital. And your mix of investors is also likely to change, especially if you become a public company. Young companies tend to be held by a very different group of investors than companies that have become more mature, that are growing slower, have large earnings and cash flows. You're attracting a different set of investors with different demands. And that has to be factored into how you run the business. If you're a company that has these cash flows that are large positive cash flows, you're not paying out cash and your cash balance are getting bigger, this is also the phase where you're going to start to feel pressure on you to return more of that cash. In fact, you could argue that this is where the trade-off on becoming a public company comes back to bite you, perhaps, if you're a founder and you want to control how the company is run. Your disclosure requirements as a public company will be greater than as a private business. You have to spend more time, whether you like it or not, catering to investors around earnings report, investor relationships. And you have to deal with shareholder pressures. It's not fair complaining about shareholders putting pressure on you if you've gone to them to raise capital. And I think at this phase, this becomes part of your job as a business if you're a publicly traded company. You're a mature growth company. At some point though, even the greatest mature growth companies will start to see growth level off. Now you're middle-aged, you're a mature, stable company. The business challenges will shift. First, your mindset has to change. Your mindset which has historically been playing offense, going after new markets, keeping keeping your growth rate high, will have to shift to playing defense. Because now you're a successful, large money-making company and others are coming after you. They're coming after your market, they're coming after your products. Your defensive mindset is very different, and some companies are not able to make that transition. If you have competitive advantages, moats in the words of value investors, you got to cater to those moats, because if you're casual and you look the other direction, somebody might breach those moats, and the next thing you know, your cash cows are no longer cash cows. Of course, in the last couple of decades, the process of running mature companies has been made more difficult by the fact that disruptors who have nothing to lose can show up in your business and undercut your entire business. Amazon opened those doors, but since in the last 25 years almost, there are very few businesses where disruption has not become part of the game. But disruption effectively means that your cash cows, your successful businesses, have to be more seriously protected. In terms of financial challenges, this might be the period where you're coasting. You got a period of stability in earnings, large positive cash flows, low growth, you're returning cash to investors. This is also the phase where if you can borrow money, your tax benefits from debt might actually mean that you can increase your value by finessing how much debt you take, increasing your debt. And if you think about what's driving your business, I hate to say this, but I'm going to say it anyway. Inertia becomes the process, because you've been around a while, you're successful. You rest on your laurels. So you do what you've historically done in terms of paying dividends and borrowing money. In valuation, there are some people who value company by just extrapolating the past, and these are the companies in mature growth where you can get away doing it, or mature stable where you can get away doing it because your historical margins might be good predictors of future margins. But there's one caveat. Talked about inertia, companies continuing to do what they've historically done. There will come a point in time where what you've done historically is no longer the right thing to do, but you keep doing it. Why? Because you're used to doing it. Companies can fall into bad habits, and at this stage, there are companies where an outsider can look at the company saying, maybe this company should be run differently. Now, in terms of capital and ownership challenges, your shareholder base will now reflect the fact that you're a mature company. You will attract investors who like dividends if you're a dividend-paying company. You will attract investors who like the way you run your business, because that's, it's called a clientele effect. Companies attract investors who like what they do. And that's a good thing and it's a bad thing. It's a good thing because you're at peace with this investor base and they like what you do. But it can be a bad thing if you as a company want to change. This happened in the 1990s with phone companies in the US. Phone companies in the US were stable, mature cash cows. They attracted older investors like dividends. But then in the 1990s, the phone business became a technology business, a telecom business. And these companies wanted to try for growth, and they were stymied because their investor base did not want them to reinvest a lot. They wanted them to pay dividends. So sometimes when things change underneath, when you're disrupted, having a clientele that likes what you do might become a disadvantage. Which brings me to the last phase of the life cycle, perhaps the most painful one, which is you're in decline. What are the things that happen in decline? Your revenues start to get smaller. Your margins come under pressure. Now, if your response is, I'm not going to go into decline, you're adopting the same response that human beings do as they age. I'm never going to get old. Guess what? It's not optional. We're all going to get older, and so are businesses. So it's not always easy to tell a declining business. It's easy to tell a declining business, just turn things around, grow faster. Much more difficult for that business to pull it off. In fact, for a subset of these declining companies, especially ones that have borrowed money in earlier phases when they were healthy, if they're not careful about managing their debt loads, decline in operations plus the debt load can cause them to face bankruptcy, to face distress. In a few declining companies, perhaps quite a few, managers try for a rebirth, a reincarnation, a revamp, something to bring them back to middle age or even young growth. They're aided and abetted by an ecosystem of bankers and consultants who tell them they can do it. and by case studies of successful companies that have done them in the past. We're going to talk a lot more about this reincarnation process and why it's so difficult and why so many companies throw so much money at it, even though they're not going to pull it off. But it's human nature. You want to be a hero. You want to kind of make this company into a growth company again. Now, as you look at the financial challenges, all your key trend lines are going in the wrong direction. Your revenues are shrinking, your margins under pressure. Now, you might say, well, all companies are bad. Yes, you're absolutely right. Having a bad year doesn't mean you're in decline. In fact, you could argue that even the best companies, high growth companies, have bad years. What you're looking for is a collection of forces to put you in decline. One is that this hasn't been happening just for a year or two. This has been happening over an extended period, 3 years, 5 years, 10 years. And they're often macro drivers. The business is changing, the economy is changing. A brick and mortar retail company in the late part of the 2018, 2019, 2020, there was no light at the end of the tunnel. Now, those companies, as we argued earlier, were declining, that also borrowed money, of course, have the additional threat of survival. They might not make it. If that reminds you of something earlier in the life cycle, that was, of course, the biggest issue with startups, that they don't make it. You're returning to that issue at this phase, the last phase of the life cycle. In terms of capital and ownership challenges, your shareholder base is going to shift again. Remember, it's been shifting all through the life cycle, from VCs to people who love young growth companies, to people who are more institutional as you become a growth company, to people who like dividends and cash return as a mature company. Now the kinds of investors you might attract are going to shift again. In declining companies, you're more likely to see three groups of investors. The first is private equity and activist hedge funds that want to change the way the company is run. In what sense? They might want to make the company, if it's being ambitious, bring its ambitions down. Invest less, return more cash, try to extract as much value. The second group of people who want to end the company's life. Sounds morbid, but they're effectively saying this company will be worth more liquidated than as a continuing company. And there are, of course, those people who live off the fact that you're a distressed company, who trade your securities, stocks and bonds and convertibles, hoping to find mispricing. The earliest and the last stage of the life cycle start to draw the same kinds of problems. Survival, how you make it through survival. But I'd much rather be a startup than a declining company, but you don't get to choose. And I think at each phase you face different challenges, and how you deal with those challenges will determine whether you succeed as a company. I hope you found this session useful, and thank you very much for listening.